All right, guys, today we have example number 1 on how credit is greater than cash or superior to cash in a lot of different ways. Today we're going to talk about using depreciation to lower your tax bill. So let's pretend we have a small business, and let's pretend that at the end of this year, 2023, we had total revenue of $100,000. So that's our tax bill, our taxable income. We have to pay taxes to the government, to Uncle Sam on this. Average small business tax, we can pin right around 15%. So we're going to say we owe $15,000. Now, we don't want to pay that 15 grand in taxes. No one likes paying taxes. And maybe we don't even have it. Maybe we don't want to take it out of cash flow. But certainly, rather than paying this, we'd definitely rather have $100,000 worth of equipment for our business if we had to choose to pay taxes on 100 grand or to have new equipment or assets worth 100 grand that we use to produce income for our business. We would rather have the equipment. How is that possible? If you purchase the equipment, small business tax law lets you write it off. So you can deduct it from your income. So you make 100 grand, but you spend 100 grand. You're allowed to deduct that from your income. So your new tax bill, the government will be taxing you on $0. And we say, that's great, but wouldn't we need $100,000 anyway to make that purchase? And the answer is no. Why? Because we can finance the purchase. Welcome to the power of good credit, you guys, and financing, okay? So for example, some financing will have interest rates of 0% to 10%. As long as the total interest paid is lower than the tax bill, then we'll save money. So on a $100,000 loan, if you're financing 100 grand, if the interest rate say 7%, you would owe $7,000. $7,000 is less than what you would have paid had you paid your taxes, right? So any money saved is a good thing. It's saved money for the business. Additionally, that equipment we're purchasing is making our business money. So not only do we lower the tax bill to 0 and we save money that way, we're actually making revenue and income from said new equipment. Additionally, you can depreciate your equipment year 1 even if you finance it, which means more tax deductions. How does that work? Well, we've already deducted 100 grand from our income year 1. We can also then depreciate a certain percentage, so 1 year's worth of the asset's lifespan. And we can even reduce our taxable bill, our taxable income, or our tax bill even greater. And we can start depreciating that equipment year 1. Okay? Now, if this were your business, this scenario is for you and your business. Would you rather A, take $15,000 out of cash flow to pay Uncle Sam, or B, use a business tax strategy to acquire $100,000 in depreciable assets that actually produce income for your business and pay $0 out of pocket and finance the purchase with good credit? Would you rather do A or B? The choice is easy. Good credit wins every time, especially for income producing assets and especially for small business. Follow for more credit tips.